Alrighty, traders. This is Blake Morrow. You are listening to the Morning Edge webinar. I almost said the daily roundup. I hope everybody's having a great trading session. I just got whipped around in the euro a little bit. I tried selling that spike, and yeah, it just continued. So the euro right back up. You know, we held above the 120, 120.70s. We dipped almost to the 618, but we held above that 50%. I should have just stuck with my original plan, which was to be long the euro down here. It spiked back up, and it's been kind of whippy ever since. So let's go ahead and just remove these lines because these are not relevant at the moment. But just note that today, the euro really has to hold above these little spike highs here. You can see them right here. Here, actually, let me grab it this way. This is where you're going to want your support to hold if you're long the euro. So if you're long the euro, that's what you should be cued in on, which I'm going to just write as 120.70 is being support. So let's go ahead and write that down. And resistance for the euro is going to be, up here at the 121.80. We were just talking about in the chat room, like the whippiness of the euro, and DK in the chat room was like, oh yeah, we can run up to about 121. That's what institutions do. And I'm like, yeah, you know what institutions do? They make you feel like we're going to 121.80, and then they drop back below 121 just when you're feeling that it's going to go back. It's like, it's messy. The one thing that I have to point out that did happen though is we had stronger inflation data. The dollar still sold off. Now Steve is probably here, and he's probably listening in right now. And I'm sure he wants. Hey Steve, you were going to mention that it has something to do with real yields.
I just wanted to remind people that I've been saying again and again that they shouldn't be fooled by the market belief that, first of all, it's a joke that they now act surprised. Clarida just came out and was like, we didn't expect that, that strong of an inflation. They're either completely clueless because everybody was seeing what was coming, right? Now, people shouldn't be fooled by the initial reaction into believing that something has substantially changed. The Fed will not do anything about it. So the initial reaction, which was a stronger dollar, etc., just forget about it. Forget about it. It's
how
not
do you
going to
gauge
live long.
How do you gauge real yields?
It's the nominal yields minus inflation.
Okay, so what's the what do you see as nominal yield right now?
Minus the real one or the reported one?
No, well, you're saying real yields aren't rising, so you got to explain that other than making a blanket.
Real yield, in my opinion, is currently near minus 3%.
So how do you get that number?
Inflation around 4%, reported, plus whatever isn't reported, which is a lot more, minus the, let's say, 10-year yield. That's it.
Okay. What I've been using to gauge like what the market is viewing as real yields is the 5-year over the 20-year. And when you start to see the 5-year yield spike up over the 20-year, and I got this really from the guys that I traded with over at Gelos. They watched this as their real yield gauge, and you're starting to see it spike up this morning. And I see what you're talking about, how like real yields haven't been moving even after like the jobs data this week. We actually, the way the market views them at 5-year versus the 20-year, we actually moved lower, but we've been actually recovering for the last couple of days. And so I just wanted to know how you came up with that calculation, why you feel that way, just because this is like,
that's not my calculation, mate. What I told you is the actual calculation.
Blake, can I ask something? Is that 2 5s the spread of 5-year and 2-year? Is that it? Is that what we're looking at?
The 20 is it
Sorry,
the
I
it's a
can't see.
5 year over the 2 year. I'm sorry,
Over the 2
5 year.
year, yeah. I just want to say one thing, because I used to trade rates and I used to trade swaps and I interest rate swaps, and I was sitting next to the bond guys.
Yeah.
Anything up to 2 years is quite a bit in, is really affected by data, by what's happening. Anything above 2 years, and especially from 5 years out, 90% of the move is flow and positioning and stuff like that. It doesn't have anything to do with actual economic data and where the economy is going and all that. It's especially if you go out from say 10 years out, it's all flow. So I wouldn't obviously this is twos versus five, so that's a little bit shorter, but I wouldn't
You
try
wouldn't read
to.
too far into like any of the like.
Exactly. But it's
Okay.
definitely a nice thing to look at, because all these, they tend to move in a certain way. They have patterns, etc. But I just wouldn't put too much emphasis on what economic data are driving this.
Okay, good to know. All right, hey, let me get through the analysis. And Steve, thanks for your answer, because I know it's a question on a lot of people's minds. Like why
Absolutely, mate.
why aren't yields pushing higher now? And maybe you can clarify what other people should be looking at moving forward to see if it's going to move the gauge for the dollar, because we have virtually the same reaction that we had last CPI, where data spiked up, the dollar actually went down. It was I want to say it was like the 15th of April, maybe the 13th of April. Somewhere around last month, where the data came out, it was somewhere around here. And yeah, I think it was right here. I think this is CPI, where we beat and the euro pushed lower and then it moved back up, and we had stronger inflation data and the euro continued to move higher. Same type of situation today. We're just, we are 150 pips higher than where we were last month, and we are still seeing an increase in inflation. So I'm wondering if the market might start believing the data right now. One of the other things I want to mention just before I continue on the analysis is when I look at the indices, I know the more sensitive market right now to rates is the NASDAQ, and as rates go higher, we see the NASDAQ actually underperform, and the NASDAQ's been underperforming. I mean, let's face it. When you talk about like the S&P's move, S&P's not too far off of all-time highs. You got the Dow, which is just right off of all-time highs, but the NASDAQ's actually leading the charge lower, and we're at levels that we haven't seen since March. If yields continue to go higher from the data today, or maybe all the combined data, if the NASDAQ's leading the charge lower, maybe we should start thinking that the market is believing in higher rates. What do you guys think about that before I continue on here?
Yeah, I mean, you're right that the NASDAQ is the most sensitive to rates, that's for sure.
It is.
Always, Blake, the more sensitive to rates is the bigger bubble. What is more overpriced is always more sensitive to rates, for obvious reasons, right? Because
right, but
the more speculative something is, just imagine money due to monetary policy flowing in, let's say, in a bowl, right? And then all the excess is pouring out. So that money that is pouring out is, the most speculative money. Now, imagine hiking rates decreases, the flow to the bowl, and, then you have a lot less money pouring out. So whatever is more overvalued is the first that's going to be hit.
Yeah, and that's hold on. What was I going to say? Sorry, I just took a little bit of profits off the dollar Canadian. I was just telling the guys and gals in the chat room. It's like I got whipped around today, so I had to, book a little profits there. If you look at Bitcoin's on its lows of the session, and you want to talk about maybe something that's very sensitive and overbought or speculative. Well, maybe we should be keeping an eye on some of these crypto markets, because if they start to really roll over, maybe that's that's what it's suggesting, right? Is rates are, possibly going to move higher. I mean, the Nasdaq's already susceptible, and we can see. I think, I'm just going to monitor this today. These are the trend lows in the Nasdaq. It's also the 50% retracement. Here, let me refresh this really quick. Okay, so this is a false breakout, right? Let's just all acknowledge that's a false breakout above those highs. We're at the 50%. Well, no, let me remove that. Dang it, I removed the wrong thing. Let me get rid of this. Well, we can keep that. That's at the 100. That's a 161% extension. So you can see how important that low is, right? So let's grab this alert and let's move it to like right here below these lows, or actually to the lows, the trend lows. Now, if you take this low right over here, the spike low in March, and you go to these highs right here, that's the 50% retracement, right? So if we start breaking below these lows, then we know we're cracking through a lot of support. And maybe that's one of the things that suggests that rates are going higher, and that, we might see
I would have to correct you again and say this is another thing that shows that the market is currently thinking that rates are going higher, because those two are not exactly the same thing. It's one thing what the market thinks and is trying to price in, and it's a different thing what's actually going to happen. Because I've stated my opinion again and again and again. I think that everybody's going to be surprised by how unwilling the Fed is going to prove in actually doing it.
Sorry, Steve, I'm just trying to trade here in the chat room. Hold on.
Yeah, mate. Absolutely.
Continue on your thoughts.
No, that's my thoughts. That the market is indeed somewhat trying to price in rate hikes. I believe they're going to find out they're wrong.
Okay, all right. So you believe you believe?
I believe the Fed is going to act much later than the average investor believes, much less than the average investor believes. So market participants are going to end up being surprised by how unwilling the Fed is going to be to actually do something.
Sounds good.
And the market is currently not pricing that in.
I don't know. Steve, here. Okay, here's my argument to that, and then we really I gotta continue on here. We've had 100% rally basically off the lows.
Mm-hmm.
So I don't know. I think the market really appreciates the fact that they think that the Fed is very reactionary. Maybe that's my opinion why we're all the way up here. I don't know. That's just...
the problem, Blake, is that the Fed. No. First of all, your argument is not a counter argument to what I say, because first of all, I don't disagree with what you said, but in my opinion, you didn't express it correctly. Because yes, they're super sensitive in acting, but only in one direction. That's the problem.
Well, that's because you and I haven't been around long enough to be trading in a.
Oh, we have in what sense? The Fed has more than proved in what direction it's willing and it wants to react towards.
Okay. Again, I don't think we've been around long enough to see inflation get to a point where they have to act quickly.
We've been trading long enough to see all the inefficiencies and the problems in the system by easy monetary policy, which they refuse to acknowledge, though. Because it's not just inflation. All this moral hazard that has been produced in the system, it's symptoms of the same disease that is now producing inflation, which inevitably would happen.
Steve, I'm sorry. The Euros just completely reversed these gains. I've got it. Let me get through the analysis.
Absolutely, mate.
I'm
absolutely.
sorry. I gotta,
Yeah, absolutely.
The whole
I'll
thing.
be here. I have time to talk about it.
All right. Yeah. Aussie is coming down towards support. Look at the euro, completely gave up all these gains. We bounced to 21.50. You know, we were joking about that in the chat room, like, oh, you know, this is what the institutions made you think that we're going back to 121.80, but here we are slipping back through 121. Guys, it's really volatile today, and you got to be a little careful. I shorted some Aussie yen. I went long some dollar Canadian off the lows, but I also got stopped out on the euro on the short side. It's been really, really choppy. I think we got to watch equities here. I think equities are going to be, you know, the most determining factor of what happens, you know, moving forward. And you can't ignore the fact that the news or the Nasdaq's trading heavy, and it's technically working the way it should. Those are previous lows. We rallied to previous resistance previous support is acting as current resistance. So break through these lows, and then you got to be a little bit more careful with what we're doing. The euro, 120.70. If that level gives way, then you're going to have a situation where all these people that were buying this morning, like, you know, when I bought like right after the CPI data, even though I didn't stick around, you know, if you were out there targeting these highs, you're going to find yourself getting stopped out this morning. So just be really careful. The cable is actually trading pretty well, but this, just really quick, this is a, you know, head and shoulder pattern. So let's just keep that in mind. I mean, it's setting up. It's not like it is. I want to watch that intraday, but what I'm more concerned about with the cable is this, 140.20 in case we break back down there. Obviously, the resistance is 141.70, which we have written right there. So the Aussie dollar, again, you know, the Aussie dollar, bit of a failure up here, and we are really struggling to break above 78.20. And so 78.20, while that's holding, there's a risk of us slipping back towards this 77.20 level support. So just keep that in mind. All right. Let's go over to Kiwi. Kiwi's trading heavy here. This is the channel that we've been talking about, and we are probably getting closer to just channel support, which is going to be, let's just call it 71.70, somewhere down here. Actually, you know what? Let's do it this way. As we make our way down towards channel support, this is previous high over here. This is going to be 71.75. Getting a little bit more granular in the analysis as we're getting close to that channel support. Resistance intraday. I'd actually watch this right here, which would be 72.50. Dollar Canadian. So dollar Canadian is flirting with this, obviously these lows here. This is the 2017 lows. As I was mentioning this in the chat room, if you guys are not in the chat room, I'll tell you where what I was saying there is, if we break back above 121, I think this is going to end up being a false breakdown. Really, I guess the level that we should be most concerned with is going to be these spike highs and all this resistance on an hourly basis, which comes in at 121.35. So if we break back above that, then, you know, but it's bearish until then. And support is, I'm going to write down 120.50. Whoops. because the low's at 120.46. So I'm just going to mark that as, important support, because if we do break below that, then, there's a risk that we start slipping towards 120. Dollar Swiss is heavy, but you can see where we are rejecting previous support, acting as current resistance. Let me go over to the daily chart really quick with the Swissy. That's still the 200-day moving average is 90.80. So that remains resistance. We're going to keep it on range for now. Support 89.85. US dollar, Norwegian krona. Little inverted head and shoulder pattern trying to develop here. Resistance still at 836. Support 820. I'm going to put an asterisk next to that. That's going to keep us bearish while we're below it. Dollar MEX. Dollar MEX is actually holding up pretty well. I picked up a little bit at 19.99 this morning. We did just spike up to 07 and then back down again. But notice how we're still trying to carve out, higher lows. And I'm going to write down, as I did yesterday, 1978. And I think resistance is that, well, I wrote down 20 yesterday. We're above that now slightly. I'm just going to write down 20 right here, 2030. And it's kind of range bound, but just keep in mind that the dollar Mexican peso is holding up. Not bad. I'm going to keep it in range. Dollar yen, 108.35, 109.65. Nothing's changed there. Dollar index. I think this is got to be a little concerning for anybody who's short. Remember, came out of a triangle. As we discussed yesterday, and moved back above 90.50 is going to start to concern some dollar shorts, right? So I think you got to be a little careful here with the dollar index, because now we're back above this broken trend line. There's a lot of day left. There's a lot of daylight left in today. So I'm just going to mark up today's highs at 90.65. Support will be at 90. And I'm going to keep it at 9. I'm going to keep it as bearish for now. But if we close back above this 90.50 tomorrow, or obviously today's highs, then I don't think you should be bearish the dollar index. Then it's it caught a lot of people short. We're probably going to trade back up into the 91, 92 level and figure it out from there. But I think you got to be a little careful, like I said. S&P. So notice how we continue to hold the 41.10 level. Dips below 41.10 are just being bought. Yesterday, 41.11. Today we dipped below there. So I'm going to write down today. I'm going to write down 4100 because we just keep dipping as really key support. If that gives way, we're bullish right now. We have to flip to range, and you could even say we're near term bearish, right? So right now we're bullish, but You got to be careful with stocks. I'm worried that, you know, people keep buying here. What happens is you get buyers that come in and they step in at 41.10, right? Every time they buy, their profits are less. So you buy it at 41.10 or close to, you know, you get a bounce. You buy it again at 41.10, you get a bounce, but now your bounce just isn't quite as much. It's like a rubber bouncy ball, right? That's losing its bounce every time it bounces off the you know, this being the table right here. And eventually that bouncy ball, you know, it just loses steam. We get the bounce, shallow, then it rolls off the table eventually, right? So I think you got to be careful with the stock market. If we close below 4,100, it might turn instantly bearish. Okay, resistance for the S&P right now. I'm going to mark up right here actually. Okay, we have some spike lows on an hourly basis, but notice if we get back above like this 41.60, then we'll be making higher hourly highs. So that would be good, right? So $60. Stay bullish, but you know, just be a little bit more careful here. Here's gold. So as we drew this out this morning on the FA.C.E webinar, 1820 held. We spiked down to 18 yesterday. We spiked down to 1817 and held. So I think we just have to write down for support right now. This 1817, and then below that is 1800. We get below that, then you know, if you're bullish gold, then you got to be a little careful. So 1800, 1817. Obviously resistance is up here at 1845. And you guys know why that's big resistance, because that is the 161% extension that you know, and the double, I'm sorry, it's the double bottom completion area. That's what it was. And if I'm not mistaken, no, it's not that 161% extension. It was technically something. I remember it from last week, but anyway, right now it's double top completion, double bottom completion, excuse me, and it is stalling the rally, and it has been for days. Silver, pretty messy in silver. The 618 is holding, so we're going to write down 27.80.85. And as I mentioned to you guys yesterday, I'm keeping it in range because it's holding the 618 retracement. We talked about this yesterday as well. But I think dip should be limited. 2660, I know that. I'm pretty sure that's what we wrote yesterday, 2660. 2660, 2780. So 2785, 2660. But the reason why that support becomes, really important is this trend line that I drew out there this morning. you can see it coincides with the ascending trend line. Sorry guys, if you can hear my dogs, I'm gonna have to take care of them here in just a second. Resistance, trend line support right through there. And last but not least, let's talk Bitcoin. Steve's most favorite asset class. Same as it has been, 60,000, 52,400. We're stuck in a range there. So guys, I'm gonna have to let you take over. I gotta deal with my animals that are out of control. So
we got it. We got it. Thank you, Blake. Let me just.
All right, guys. Have a great one. I'll catch you guys a little bit later.
Yep.
Thank you, mate.
Thanks, guys.
Okay, I'm just uploading the bias chart and putting it on the chat room right now, and we can move on. 1, 2, send. Okay. Couple of things I wanted to mention that we didn't have the time to mention in FA.C.E. Sterling has been doing very well over the past couple of days, and I think one of the main reasons is that was it yesterday that it was the first day with 0 deaths, COVID deaths, since I don't know when. So the UK, they were one of the most rapid moving countries in terms of vaccination, and you can see the results.
Yeah, they did very well indeed.
They did very well. Yeah, I have a lot of friends. My brother is in the UK, and they were telling me this is moving at a ridiculous pace, which is good. So that's we also had GDP, which came in a little bit better than expected. Still negative quarter on quarter, but I think now we're going to get to positive territory. Industrial production, manufacturing production, both beat by a margin. So the UK, tentative steps of growth, if you want to call it that, and definitely outperforming other countries, that's for sure. So you see the pound, which is doing well, and euro pound, I've been saying for a while, I think euro pound wants to revisit 84, and then I think it's going to have to probably make a big decision. I think if we get to 83.5 to 84, I think is the range where there's going to be some kind of big reaction. I don't know what the catalyst is going to be, but if anybody's looking to be long this pair, I think you really need to wait for it to get there first. And the other thing I wanted to point out for people who trade the kroner is that we had Norway's GDP. It came in a little bit worse than expected. The headline, the revision was a bit higher. So all in all, kind of okay numbers from Norway. Remember, their inflation is at 3%. So, and they're still on track to be hiking later this year. At least
I'm
that's
so
what
curious to know what the real inflation rate is globally at the moment.
Yeah,
must be something that would make people's eyes
near double digits. That's what I would say.
I definitely believe so. Yes.
Yeah. So those are the two things I didn't have time to mention on FA.C.E, and it's worth noting. Otherwise, we obviously had the US CPI print, and the market thinks we're going to get tightening of some sort.
Yeah, good luck.
I'm still not convinced. I'm in the same camp as you. And
yeah, good luck. And whenever we do, it's going to be very little in comparison to the size of the problem.
Yeah.
In essence, the Fed's focus will remain the asset price, maintaining asset prices, because they maintain the charade of an actual economy and an actual economic recovery. So whatever decision they make until the problem of inflation becomes monstrous and creates a public uproar, which we're not there yet, because people they take time to understand and realize what's happening. They will be doing everything with the main criteria being preserving asset prices. That's why I believe that these repricings that the market is going to do, based on the notion that higher inflation, okay, that means high rates. Okay, what does that mean for gold, for example? Look at this. If market participants understood basically what's happening today, gold should have been $50 higher.
Yeah, because of real rates, right?
As simple as that. And instead, because there are some people that understand and they're buying it, and many people that don't understand, and they're thinking with the simplistic notion, oh, they'll have to increase rates. Okay, so that's not good for gold, right? Absolutely wrong. Because as I said, when they end up increasing rates, it's going to be a fraction of what they should. So real rates are going to keep moving lower, which means that gold's actual value should skyrocket. And in my opinion, you should take this as a gift, the fact that it isn't. Because once even the foolish market participants realize what's happening, then there is going to be so much repricing that's going to be needed in things like gold, silver, etc.
Indeed.
That the type of movements that we're going to see, they're going to make heads spin. I really believe it.
Yeah. I mean, if you think about it, right, with the Federal Reserve balance sheet up, I don't know how much percent in the last 20 years, and silver is still 50% off its highs, or all-time highs. I mean, which is crazy. But anyway, let's see. So,
other than that, I'll just reiterate the obvious. We talked about this, and I'm going to keep mentioning it, right? This, and then bringing in focus again the importance of the 4110, 4115 level for the SPX. Okay, now as long as we have the previous chart, I would expect in general the Nasdaq to underperform the S&P, but I'm going to take my signal from the S&P for when we should seriously consider being in the short side. And we're not there yet. We made an attempt earlier today. We made an attempt yesterday, but as you see, the bulls are still holding, right? Hope dies last. And you shouldn't be fading a strong foolish market just because fundamentally speaking, it's what is happening is different than to what it should be happening. Although we need to also reiterate that in general, inflation does benefit stocks. Especially in the older times, the vast majority of companies had intrinsic value, meaning they did own assets, they did produce assets, which would do good with inflation. So, inflation should, theoretically speaking, get repriced to the price of stocks. Of course, now it's a different conversation that, for a big period of time, stocks have been pricing in all sorts of things, the vast majority of which makes 0 sense. So anyhow, valuations are just beyond extreme and beyond ridiculous. But this is the market we have. What can you do? I mean, this is the market that the moral hazard of 12, 13 years of extreme monetary policy, now accompanied since a year ago with the excuse of COVID by reckless fiscal policy, creates, right? In any case, having to do with markets themselves, I mean, focusing purely on the charts here, we've seen this reaction higher in the dollar based again on the same flawed assumption that there's going to be rate hikes. Now, listen, because somebody wrote, important is what the market trades, Steve, not what or if the Fed will do in the end. Yeah, I totally agree with you, Martin. That is exactly why I'm not advocating that people should ignore the price action, because, as I've said, the market might take some time to come to the actual realization of what is happening. I'm just trying to look one step forward, right? I'm not trying to fade the initial reaction of the market, and I do believe that there is a chance that we are going to see the next few days some kind of a counter trend move, at least in regards to the dollar, based on the belief that the Fed is going to act. Clearly speaking, that should also produce a counter trend move for stocks. Because if the market wants to price in that the Fed is going to act for the dollar, it then also has to price it in for stocks, and higher rates are negative for stocks, theoretically speaking, positive for the dollar, right? So I wouldn't be surprised based on this for the market to produce a counter trend move. Although technically speaking, so far today's move is not enough to trigger any type of counter trend moves, right? So far, with the key phrase being so far. But I wouldn't be surprised. So if I see the market trying to follow this path for the next few days, I'm not going to try to fade it just because I believe that the market has completely misread the situation. I'm just going to let it unfold happily because foolishly the market is going to offer me greater buying opportunities in several stuff I want to be buying. Okay, and you know what they are. I mean, you know very well how I'm thinking and what I believe should somebody should own and what they shouldn't. So keep that in mind. Now, going back to gold and silver, still being capped in gold by this massive confluence of resistances between 1850 and 1855. The market, as you see, is refusing to move one direction or the other because, on one hand, they know that inflation is extremely positive for precious metals. On the other hand, they're thinking the Fed might act sooner. But I think that prudently so far, there doesn't seem to be a lot of people that are really willing to sell precious metals, especially with inflation exploding higher, and they shouldn't. Right now, would I be surprised if I see the gold and silver move lower during the next few days? No, I've seen more stupid things happening in the markets than that. I will just believe that it's an excellent buying opportunity. As simple as that. But as I said, I'm not going to try to fade the counter trend move. I'm going to let it unfold. And when I see that it has run its course, and perhaps when we start getting the first signals from the Fed that are going to start giving the market the real idea of what's about to happen, then it's going to be a great opportunity to buy whatever you haven't bought yet or whatever you don't have. Now, having to do with the rest of the questions, PLPA, okay. Here is palladium, here is platinum, sorry, nothing has changed. I don't need to reiterate every single day the same thing because you see that the formation is still actively unfolding, right? I still don't see something bullish with the way this formation is unfolding. Of course, if we suddenly see a move with momentum breaking through it, then I'm going to go along with it because the direction I'm looking is higher anyhow. But until that happens, I wouldn't be surprised if we see one more low. Now, palladium still consolidating near the highs, and here is copper, too powerful to fade, right? So keep that in mind, too powerful to fade. There was also a question about AMD. Here's AMD approaching. You see why you shouldn't be jumping the gun with corrective moves, because corrective moves are notorious for being tough to trade, right? So we had this breakout, we did produce new highs, and now we seem to be in some other type of corrective move. So let me give you, because I have a good understanding of the fundamentals here as well. First of all, let me tell you that AMD is kicking Intel's butt for quite a few years now. So AMD is a company that does amazingly. So fundamentally speaking, I think it's a good company to own. Now, would I be buying it here? I might. Why? You see why? Because we're backtesting a very, very, very important support area. Now, having said that, do I think that the correction lower is over? I'm very skeptical about it. I'm very, very skeptical about it. I think there might be more to come. That's what I think. I think there might be more to come in this corrective move. There you go. But I'm telling you in advance, this is one of the companies I would be more than glad in buying at better prices. Right. Now, somebody can also make the assumption that this is a head and shoulders formation here. Shoulder, head, shoulder. And technically speaking, there is no mistake in that, other than the obvious mistake that you shouldn't be assuming something is a reversal formation until you actually get it to trigger, because it's more likely to have a continuation formation than a reversal formation. But does this really change something? No, it doesn't. Why? Because the support area is again the same. The neckline is again the same, roughly at, let's say, 72.5, let's say. So you can buy it here against these lows, so you get an amazing risk reward ratio. Alternatively, alternatively, there you go. If you believe it's moving lower, you can wait for this head and shoulders target to be fulfilled. There, target 47 to 48. There you go. That's what I think about AMD. So last time we checked it, we were here. I said that this should break to the upside. It did. We did get ourselves new highs. You remember, you've heard me say it a billion times. Breakouts from triangles are usually terminal moves. As you see here, we had a breakout from the triangle, and it was a terminal move. We did get our higher high, and now we're getting a deeper correction. That's why I said I think we might see lower prices from here. And if we do break through 72.5, I wouldn't be jumping the gun and buying it. I would want to buy AMD if I wanted to have a stock portfolio in general, but I think we break through 72.5, you should wait, because in my opinion, you'll probably get much better prices. The first area of support I would be looking towards is this horizontal support resistance area at 58.5, 59. Okay. So that would be the very first area I would be looking for support once we break through this, if we do. Okay. There's some new competition in the market. Trust me, having to do with these markets, there is no new competition that can immediately trump a company. You know how many years it took AMD to actually work silently, let Intel mess up based on its complacency of being the leader for many, many, many years, to come on top, many, many years. And there are a lot of companies that have tried in the past to compete in that market. Even if I go back 20 years, I can remember Cyrix, and since then we've had a few more attempts.
Their processors, the Cyrix processors, initially were very good. Remember those?
Yes, I owned one actually.
I had one as well.
Me too. Yeah.
133. I remember. What was the megahertz back then?
Yeah, I actually got there 233 megahertz. It was super expensive back then, but it suffered greatly because there was it was very badly supported, having to do with drivers, and that half killed the processor. And then they came into other problems. The existing companies had more cash in hand to go through rough times and compete, and then they faded out, and that was it. They were gone. So I see the trajectory in which AMD is in both CPUs and GPUs, graphics cards, for those that don't know the acronyms. And I believe it's a company that has a bright future ahead. It also has very good leadership. I don't remember the name of the female CEO it has now. It escapes my mind, but
I don't.
She's really, really good. So it's a company I think has real value. Yeah, like NVIDIA. Yes, NVIDIA is an excellent company with very limited competition. Although somebody can say here that NVIDIA is having more upcoming competition than AMD has, because recently Intel started entering the GPU space. They're now going to start by producing GPUs for laptops, for portable devices and portable computers. But their plan is within a year to also enter the market, the competitive market of graphics cards for computers. So NVIDIA has more to lose in this than AMD does. Keep that in mind. Sorry, NVIDIA has more to lose than yeah, AMD does, definitely. So between the two of them, plus I want you also to consider one huge risk here, and this is a huge risk. One of the reasons that NVIDIA has rallied so much is mining, right? And we know that. Now, I cannot stop thinking about the amazing risks in what's going to happen with NVIDIA price when and if the cryptocurrency market implodes. So NVIDIA also has in its foundations at the moment, having priced whatever it has priced, a big ticking bomb, right? Whenever we enter a big bear market, you know what happened in 2017? In 2017, when Bitcoin and the rest of the cryptocurrencies tanked, the market was flooded with used graphics cards. When I say flooded, I've never seen that before. It was the exact opposite of where we currently are. Currently speaking, we also go through a situation that I've never lived before. My graphics card is 2 years old, and I could sell it today double the price I bought it 2 years ago, which I've never seen with technology ever in the past. There is such a huge supply shortage that graphics cards that used to sell for like $70 are now selling for $300 because people need graphics cards, and many times they can find any of them anywhere. So in 2017, we had the exact opposite. When cryptocurrencies tanked, the market was flooded with used graphics cards. So people were not buying new ones. Many of them were just buying used ones at a good price, right? So imagine when we get the next bear market in cryptocurrencies, and we will. I mean, even if you want to make the argument that cryptocurrencies are here to stay forever and they're going to take over the world and going to replace the dollar, I'm giving you the most bullish, outrageous scenario, right? Even if that's what your thesis is, at some point, they're going to go through a big bear market again. And when that happens, you're going to have the market flooding with graphics cards once again. Guess what's going to happen that year to NVIDIA's net income? You get what I'm saying, right? So there's this huge underlying risk for NVIDIA. Yeah, IBM is actually, Lorraine, that's a good point. IBM is developing the first 2 nanometer chip. That is true. But that is still on a research basis. No, I'm not saying that they cannot. It's a different thing being able to produce a chip, and it's a different thing to be able to mass produce a chip. And for these markets, this is amazingly important. For example, Intel got left behind from AMD because they're now in their 6th generation of 14 nanometer chips, right? They were supposed to move from 14 nanometers to 10 and from 10 nanometers to 7. They had the ability to build these chips since 5-6 years ago, but it has taken them 5-6 years and they still haven't managed to find the production process that will have a good yield. Let me explain what that means. When you're building chips with very low nanometers, part of the yield you produce is useless, doesn't work. You have to throw it away. So until you get to the point that you can massively produce it with a small yield of defectives that you're going to throw away, it's not financially worth it, right? So it's a different thing if IBM can produce a 2 nanometer chip, and it's a different thing if they can mass produce it and sell it. Between the two of them, we've seen in practice recently that there might be many years between the two phases. And within these years, you never know. There might be one of the other companies that seems to be lagging that will be efficiently able to put it in practice and mass produce it despite being later to the party. So keep that in mind. Anyhow, a lot of tech conversation today. Speaking of NVIDIA, by the way, it's quite a weird, this is quite a weird chart. That was an amazing false breakout. Then we get the false breakdown, you see. Then another move higher. It's not this is not an easy chart to read. Looking shorter term though, admittedly, doesn't look bearish, right? It doesn't look bearish. Clearly though, there's been a big loss in momentum. Just look at this. I mean, we were in September of last year, we were at 585 and we're currently at 561. So, sorry, I meant, yeah, September of last year. Yeah, so many months have passed and the price more or less has done nothing. When is that going to end? You know, not sure. But, you know, currently speaking, there doesn't seem to be a, you know, a very bearish interpretation of this chart for the time being, at least. I think it remains bullish. Yeah, I talked about it. AMD might be ahead and oh yeah, you wrote it before. I just saw it. Any other questions, guys, girls? Anything else you want us to look at? FX, equities, whatever it is, commodities. JNK. Quite an amazing recovery, but you can see what the problem is here, right? Momentum has steadily started waning since a long time ago. So this can work two ways. One, two. But in any of the two scenarios, I think the move that's going to follow is going to be very strong. So either we end up breaking higher or we break down. I think the move is going to have momentum. So I think somebody needs to be patient and brace because, you know, what's coming next is probably going to be volatile. I would probably favor the downside if you're asking me. I would probably favor the downside. G-Nog. Whoa. Yeah, this is not good looking. Yeah, of course, somebody can claim like, you know, how low can it go? I have no idea. But you just remember that things can go to zero, right? So keep that in mind. Definitely, whatever this was, golden nugget online gaming. Okay, this was clearly a bubble of some kind. And this bubble has burst. It's the usual bubble chart, right? So I wouldn't be looking to buy, I can tell you that much. I think this might as well go back to zero or go to zero because obviously, you know, at some point it opened at, what was it, 970 or whatever. I wouldn't be surprised for it to be trading below that very, very, very soon. Kane. We've had a look at it in the past. Yeah, this is a surprising move. Up to this point, this was looking like a perfect corrective rebound to an impulsive move lower. But in trading there are no absolutes, right? I mean, you have formations that that most times they do X, right? But there is no such a thing as absolute. And that is exactly why we've been saying again and again that risk reward, managing your risk is extremely important, because you had every valid reason to believe this is going to be resolved to the downside. But you still need to have a specific risk that you put in place, right? You need to have a specific risk that you put in place and you say, I'm wrong above that. In this case, you would say, I'm wrong above the trend line resistance of this formation, which, by the way, not coincidentally, once we broke above it, it acted as support. And it acted again as support, right? Both here and there. Now, where to from here? I don't know. Meaning, this is too stretched in the short term, right? So higher, yes, okay, fine. But where would you buy it? I guess here. Might offer some value near 7.5, in my opinion. I wouldn't be buying it higher than that. I think it's overdone for the time being. We've started seeing some RSI divergences there as well. So yeah. XHB GNOG question, is it like head and shoulders? It can't be a head and shoulders formation because the implied target would be negative 15. So forget about it. This is the usual bubble build, bubble burst type of chart. It can't go negative, we know that much, right? XHB. There you go. Last time we checked it, I said, be careful, don't chase it. Why? Because it looks to me like it has built now an ascending wedge. And look at it crack. Be very careful here. Look at the runaway gap we built there. One day we were trading above the wedge, and next day we gapped lower and closed below the wedge. That is a very, very, very nasty looking chart. And it's the SPDR, the home builders thing. You know why this is happening, right? Because the market is thinking, oh, they're going to hike rates and mortgages are going to, become more expensive. And of course, since this industry is based on the assumption that, cheap money is going to keep fueling forever, houses, which it will for some time. The market is now getting a little bit of a jitters, like, oh, are they going to hike? Because if they hike, mortgage rates will have to move higher, and that is definitely going to reduce demand in a market that's anyhow very, very, bubblishly looking. GLE. Is this the GLE you're looking for? S&P, I don't have to say, just answer me about GLE. S&P, I don't have to say anything else. As I said, 4110, 4115, key support, sorry. We break below it, then we target this trend line support. So we close below 4110, we open up the door for more downside, and we produce at least a short-term lower low, which is finally a signal that, some kind of a deeper corrective move is coming. And if you look at the VIX did break out from this channel that looked corrective. So that's also a bullish sign here for the VIX, so a bearish sign for equities. So they look like they might crack. Keep that in mind. But they haven't done so yet. They might do within the day, though, in my opinion. As long as the market wants to keep believing that today's news equals higher rates imminently, I explained before why I think this is the wrong assumption, but it doesn't matter. As long as the market decides to bet on that horse for a period of time, we should see equities sell off. GLE, Société Générale, okay, the bank. This one, okay. Whoop, sorry. Here. Huh, quite a nice recovery to a completely worthless stock. I happen to know Société Générale specifically as a bank. For reasons I don't have the time to explain now. If you remind me, I'll do it tomorrow. So I can tell you that it's a horrific organization, bureaucratic like hell. Of course, traditional banking, as I've said, is a dead business model. There's no question about it, but it's still in a nice recovery. Watch out, we're testing resistance as we speak. And in general, I think for a bullish breakout to happen, we need to go through the red trend line. In the short term, it's overdone. We have RSI divergences. So keep that in mind. I wouldn't be chasing it here if that's what we're talking about. Look towards 23. A retest of 23 might give you a better opportunity. Okay, guys and girls, see you tomorrow for the rest. Thanks, Del.